Good evening, ladies and gentlemen. Welcome to Business Today Television in our ongoing series of how the temperature of the red hot capital markets is. We continue to meet a series of individuals who have a deep command over the market and have an unusual understanding of how the internals of capital markets, whether it's equities, bonds, commodities work. In that connection, we are joined today with Mr. Swarup Mohanty. He's the Chief Executive Officer at Mirae Asset Mutual Fund and has spent about 25, 27 years in the market in various capacities, the last 6 of them being as the Chief Executive Officer at a wonderful asset management company that has given fantastic returns to long-term mutual fund holders. Over the last 12 years that Mr. Mohanty has been with Mirae Asset Mutual Fund, a series of extremely good and very well received equity offerings from the AMC have done fantastically well, and Mr. Mohanty oversees about 1,16,000 crore rupees in assets over various schemes. That's up about in the top 10, right up there. And the number of folios, that is individual investors, that Mirae Asset has is something like 56 lakhs. Mr. Mohanty, welcome to Business Today Television. I am sure these days are glorious and you have a lot of things on your plate. How are you seeing the market temperature and where do you think markets are headed?
Thank you so much for having me. This is my first time with your channel, so really appreciate being here and thankful for the opportunity. See, the markets always reflect what is around you, and when you look at the country, it can't be more buoyant than ever. I mean, in my entire career of being in this industry, I have never seen India's data points as strong as they are at a time when global data points are completely on the other side. So clearly, the markets deserve to be good, and that's where they are. So I agree with you. Very good, buoyant times, and for the first time, I can say deservedly so.
Absolutely. So, Mr. Mohanty, let's drill down into one of the most popular and the most fantastic product designed by the mutual fund industry, which is the systematic investment plan. A large part of this wonderful rally and the support that the market direly needed over the last 1 year when our foreign funds were not as friendly to domestic markets as they are now was the SIPs. We've seen magnificent growth from about 3,000 crore rupees per month about four years ago to somewhere like 18,000 crores per month as equity inflows. Where do you see them headed, and what is the consistency pattern that you've observed? Is it geographically more strong in some areas, or are newer sectors coming up in this monthly definition of inflows into lots of equity funds, especially in the top ones that you manage, sir?
I think you said it right. I mean, to go from 3,000 crores to 18,000 crores is pretty staggering. And it's changed the basic structure of the Indian stock markets. I mean, earlier, the markets were dependent on FIs buying and selling. Now, the real hero of the market is that individual SIP investor who is keeping on buying. It doesn't matter whether one individual stops or the other continues. It matters to the market if overall the pie continues to grow, and that's what it seems to be. Now, when you look at the geographical expansion, there's a basic way the markets have come in from the SIP perspective, where at an industry level, we have the top 30 cities, and then after that, the rest of the cities. It broadly follows that pattern. But what you must actually realize is that everything changed post-COVID from an investment sort of environment of this country. You can say that, what started with demonetization sort of took off after COVID. And let me give you some data points. Before COVID, say the industry would have already been around for around 20, 25 years. The
Yes.
total number of folios in the industry were 2.3 crore folios. Post-COVID, in the first year, we added 1 crore.
Wow.
Now, on an average, we had 70 to 80 lakhs folios. So, in the next 3 years, I mean, that would collectively be 5 years, we will have more folios or more investors than what the industry added in 25 years. That is how
Wonderful.
financialization is changing, and it's changing through the SIP route. And it's a fantastic participative way of investing in the market. And it's great to see that it's become the go-to investment solution for most Indians who are adding to this financial asset journey as we speak.
So, Mr. Mohanty, let's drill this a bit deeper. One of the most very well received and very popular products in the market these days is exchange traded funds. When I look at your wonderful balance sheet that you just shared with the unit holders, about 12 schemes were launched by Mirae AMC in the last financial year, and of them, 5 were ETFs, various parts. There was one for artificial intelligence. There was one for global auto space, and a lot of people have spoken to me personally on the NYSE FANG ETF from Mirae, which is immensely popular and has done a fantastic job on mimicking the highest beta stocks in Nasdaq 100 index. I just wanted to understand, when you speak to your peers in various other AMCs, what is driving this ETF mania that we see in the Indian mutual fund industry?
At a retail level, the ETF journey or the passive investing journey is just about starting. Let's understand two things about investing when it comes to outsourcing investment to a particular fund manager or to an index. When you come to a fund manager or you come to what we call active fund management, you invest in a fund, and the expectation of the investor is to give returns above the market being the benchmark, which is the index. And since the active managers aspire to give returns over the benchmark, they charge a fee. Now, in that process of aspiring to give benchmark beating returns comes the risk of underperforming the benchmark also. In that lies the other set of investors who will look at the market returns and will say, I will not take this underperformance risk and let me just take the market. And that is where the birth of passive investing, or one form of passive investing is ETF investing, starts. And if you look at the data points in the last 4 or 5 years in particular, as markets mature and as markets become transparent, the ability to generate alpha in many companies or many indices starts shrinking.
Absolutely.
That's how this shift happens. We are at the threshold of that. I won't say that it's really taken off in a big way, but in the next 5-10 years, we do see growth in both sides. India is this unique country which now sits in front of you as an investor, that there is enough talent of fund managers who can give you alpha, and there is enough brain in this industry to give you fantastic ideas in the form of indices, like you mentioned, some in some of our basket indices. And hence, it's a great time to mix both and form good portfolios from an industry perspective.
Wonderful. Let's address the other part of the mutual fund industry, Mr. Mohanty. We've seen a fantastic rally year to date, not only on the Nifty but the small cap and the mid cap sectors as well. They are also, scaling record peaks, and the way mid caps and small caps are rising these days. In the market, it seems that there is this great feeling of missing out from the market. At the same time, a lot of our friends who manage money in the small cap space have asked to stop inflows. Is that some kind of an indication, when you talk in your peer group, that the market is overheated and maybe we need to cool it down, and at the same time, also manage expectations of investors, especially newer ones who want to see magnificent returns, which are 2 standard deviations away from the mean, not materializing. So, how are you reading this theme where top fund managers are asking the marketing teams to pause money into small cap funds?
So I can give you our view of it. We have always highlighted the fact, and especially when you start managing money in the mid and small part, is that size is not that big an issue, but the pace of the size is always an issue. Because when you hold a stock, the stock comes to you in two parts. One is the market cap of the stock, the other part is the free float of the stock. There is that much of free float which we like to own because there comes the liquidity part of the stock. So especially with smaller market cap of or market smaller companies, the free float is less, and hence we say that they are less liquid than the bigger stocks. So for us, when suppose in 2016, we are probably one of the first guys who entertained not stopping but soft closure in our then mid cap fund, the emerging blue chip. We restricted it to a SIP amount, and it's continuing since then. The fund size then was 2,600 odd crores. Today, that fund is 24,000 crores, right? But since the inflow of the fund has been mitigated to a certain level, managing that funds become better, is our view of looking at it. It is not a reflection of the market, let me tell you. That's how we viewed stopping of funds. Now, at some point of time, each manager would view it that way. It may not be a reflection of the market levels, is what I'm trying to say. I mean, each
Okay.
fund has its own reason for stopping funds. I've given you our view of why we stopped emerging blue chip then. As on date, it is still restricted to 2,500 rupees SIP per pan, but it's a 24,000 crore fund.
Mr. Mohanty, let's take the discussion to a different plane. I was interested in finding out, and as history has showed us over time, that record highs are also accompanied by a very strong pipeline of fund offers to newer and existing investors. It's typical of how you see markets maturing. We've seen that happen in the early part of 2000 and 2007, and of course, every other day I read a new FPO coming to the market. What do you think is the pipeline for the entire sector? How many funds are likely to be launched? And it's okay. I mean, AMCs look at completing their menu of offerings, so there is nothing really bad or incorrect about it. But I just wanted to understand what's the sector pipeline.
No, as we speak, we are in the midst of an NFO ourselves. We are in the midst of our multi-cap fund, and we did not have anywhere below the mid-cap fund. So this is our first venture into a bit of small cap, and so we're adding that to our portfolio of funds. But yeah, I think some part of what you say is correct. That the environment when markets are buoyant are conducive to investing, because when the markets are good, that's when investors try to flock in. Is the truth. But that does not mean funds try to time it then. Funds try to finish their product basket is more true than trying to time the market. Now, when you look at new fund offers of any AMCs, if we discuss, go back to the discussion earlier between active and passive. When you look at the active side of the investing, the regulator has come in and formed a proper basket for us. There are this many categories that we can launch funds on both equity and debt side. So launching new funds is limited to that much. But when you look at the passive side of investing, the beauty of passive side is wherever there is an investable universe, you can form an index on it. And on that
Absolutely.
index, through factors, you can give multiples. So actually, the plethora of launches that can happen, or the ideation of new ideas that can happen on the passive side, will be far larger than on the
Absolutely.
active side. So when you look at new funds coming in the near future, and when you look at, if we have added 12 funds, five or six were on the passive side, that's a reflection of that underlying truth that you can add more ideas on the passive side, on the active side, and that is true worldwide. So expect more funds to be launched on the passive side in the coming times, because on the active side, the ideation is limited. But yes, as we speak from an industry perspective, we have a host of new young fund managers also coming in, young in the meaning of NAV history I'm talking about, not in the form
Yeah.
pedigree of them as fund managers. There's some fantastic fund managers in the industry now who are making new asset managers. So they will come in with their new fund offerings. So from an investor's perspective, yes, they will continue to get new offerings from from the industry as such, and the pipeline should be fairly strong.
Okay. Interestingly, what you see, the SIP industry about 5, 6 years ago, a very small catchment of people putting in money on a monthly basis is exactly where the ETF industry stands today. 5 years from now, ETFs in both in terms of numbers as well as in terms of size would probably be 5 to 7 times bigger than what it is now. In fact, India's two largest funds at the moment are ETFs for the Nifty and the Sensex respectively, and the corpus is huge at that point of time. Mr. Mohanty, let's focus on the markets. I wanted to understand thematic plays. Generally, it's often said that themes, especially sector specific themes, should be a minuscule part of your portfolio because the risk there is substantial for the sector to go down dramatically. Where do you see the thematic part of the mutual fund industry being overheated?
Actually, Sharindra, you talked about a very interesting part of investing, which is sector investing versus thematic investing. Let me tell you, when you look at a sector is a subset of a theme, and themes grow over a period of time. We run, say, a consumption fund which is 15 years old. When we launched it 15 years ago, it was primarily FMCG. Say 4 years ago, when we launched the healthcare, it was primarily pharma. When, say, 15, 20 years ago, our fact sheets used to read banks. Then it became banks, NBFC. Then it became bank, NBFC, financials. And now it is banks, NBFC, financials, fintechs. So the point I'm making is themes grow over a period of time, and sectors are what you call very time specific, very cyclical, but themes can be viewed at as long term investing. In India, broadly, investing is still in market cap. Broad part of your portfolio is large cap, mid cap, small cap. Indians have yet to convert themselves into identifying themes as a long term structural play. If you look at our consumption fund, I'm taking that example not to sell the fund, but to give an example, it's a 15-year-old fund. And if you look at the track record and the composition of that fund, the balance sheets are fairly strong and fairly diversified, right? So one has to wake up to thematic investing in a bigger way. The Globe is given up market cap investing long time back. But in the next decade, we will see the birth of thematic investing in a big way. And from our side, we have three large themes as we speak. We run the consumption, we run the banking and financial. In fact, banking and financial, we run both the active and passive side. We run in the passive side, we run the bank ETF and a financial index, which we have created ourselves. So
Yes.
that's what we talk. But when you look at the house view on themes, I think, we do back the fact that manufacturing is something which has given birth to India. It is now or never, right? If India has to grow from here, it cannot be just a service-led sort of economy. It has to move manufacturing, and some amount of it we have already started, seeing last 3, 4 years, because the government-led PLI is backed by the fact that we are one of the cheapest labor providers to the world. And secondly, our corporate taxes today comparatively are probably cheaper to the entire globe. So from that perspective, we are seeing green shoots of manufacturing happening. And we say that is the beginning. The opportunity is large because
Right.
not only there a possibility of building good manufacturing, plus there is a supply chain diversification on both China plus one, and now we are talking about Europe plus one. So the opportunity is there. Housing revival is real. We feel housing definitely has gone through the bad days. And today, when you look at Mumbai itself, you will agree with me that most of the ready-made inventory is gone. You have got,
Yes.
and RERA has come in and done its part. Auto, in both auto and ancillary, we see great opportunity because it's coming off a low base post COVID. So, and right now we are seeing the four-wheeler sales the way it is going. We see a great opportunities there. The rural recovery is something which we have to watch out for. We are watching that very closely. We hope with good monsoon, and that's
Right,
the
sir.
view is if monsoon is good, then we could go out better. Banking was a call we gave 2 years ago. Maybe one can look at healthcare as a structural play in the next 1 year also. So that's the broad theme house view that we have from our side.
Mr. Mohanty, since you mentioned house view, I'm sure every morning somewhere between 7:45 to 8:15 there would be a daily meeting of fund managers, analysts analyzing stocks to buy and sell for today's market. I wanted to understand what's the view on the Nifty as far as Diwali is concerned and Christmas. Of course, we are partying much earlier in 2023 ahead of festivals. It's been a fantastic rally, somewhere like 13% rise on the Nifty in the last 5 months. But where is it headed? Would you stick your neck out?
No, I think we've been very constructive of the Nifty post-COVID. I think we had said that the risk reward is in favor of large companies, and that's something which was a call we had given out post-COVID. So we still remain constructive on the Nifty because at the end of the day, data plays out, and data is in favor of large companies in India. The balance sheets are looking better. Please, when you look at Nifty 50, 37% of it is banking and financial. And the
Yes,
cleanup banks
correct.
post COVID is something which we all talk about. At a time when global banking is in disarray, Indian banks are shining, and the results per bank is playing out in front of you. So extremely constructive about the Nifty, as you know, some amount of sanity prevails, and there's some amount of issue on both global inflation as well as interest rates. Once that is taken care of, and the data points of India come out, India will remain a favorable country from
Right.
flow of funds perspective. With 16,000 crores or 18,000 crores of SIP money, some amount of it will continue to be a buyer in the Nifty space as we speak. Bulk of the money remains in the Nifty space. So at every fall, I feel there is a buyer there in the market. Earlier, the foreign players were only the buyer. Now there is an Indian DI in the form of SIPs also there in front of you. So with when markets run up like this, always one suspects if there are any sort of bubble there. There could be some minor sort of correction, but we remain constructive on Nifty. The question I ask to every Indian investor is, what are you looking at? And here I'll refer to the Sensex, is that are you looking at India 6.5 trillion, or are you looking at 65,000 Sensex? Call is yours. If you're looking at a long-term view, maybe in the short run, India looks a little expensive, but in the next 5-10 years, India is a country to be held very closely in your portfolio.
Wonderful. Mr. Mohanty, my final question. Where is the bulk of your personal savings invested?
See, my investments lie in equity. I was 70 till last year, but I'm taking my equity up to 80% now because I'm only looking at 6.5 trillion Indian economy. It's the only country in the world which is giving you a economy double status in the next 8 to 10 years. And then it coincides with my working cycle also. I have some 8-10 years of work life left. So I want to make the best of it before I start my retirement life. So bulk of it remains in equity. I use debt as a sort of what can I say, allocation tool to come into equity when markets go down, because I have the cushion of a good PF also, so that
Yes.
when I include the debt part is already taken care of from a retirement perspective. I'm a firm believer in the large companies of India, not very much into the small cap space yet, because my portfolio return expectation is 10 to 11%. If that is my expectation, then I will take risks which will measure up to that. So that does not make me a better investor or a lesser investor, but I just want to play to my portfolio goals. So bulk of my investments are in large and mid, a little skewed towards mid, but that's my broad portfolio, all in mutual funds.
Wonderful. Mr. Mohanty, you're one of those rare people who put in money where their mouth and profession is. All the good luck to you. You've raised your equity allocation to 80%, and the buy and hold strategy works magnificently in a bull market. That's the best way to ride this fantastic rally that we are seeing unfolding in front of us. Thank you for your time, Mr. Mohanty. We wish you all the luck, both in terms of the SIPs that Mirae Asset will continue to join, and all the luck for the fantastic performance that Mafang NYSE ETF has shown for rest of your schemes. Thank you for joining us. It was a pleasure listening to your views.
Thank
That's
you
it,
so
ladies
much
and
for having
gentlemen.
me.
That's it, ladies and gentlemen. This is how the overall structure of the mutual fund industry is, where we are seeing a lot of inflows coming in a regular basis via systematic investment plans. The sector as a whole is looking to launch newer and better products to make life easier for investors such as you to invest a large part of their savings into equity assets, to do it very comfortably and to make it easier for you to ride this fantastic unfolding of a great bull market that we are seeing in the Indian economy. Thank you for joining us. Remain glued to BTTV.
If you like the video, do like, comment, share and subscribe.